The secondary mortgage market is the engine of real estate finance on the national portion of your licensing exam because it provides the liquidity necessary for the primary market to function. On the exam, you must distinguish between the primary market, where loans are originated, and the secondary market, where existing loans are packaged and sold to investors. Think of the secondary market as the recycling center of mortgage money. When a local bank lends money to a home buyer, that capital is tied up in a 30-year commitment. To get that cash back so they can lend to the next borrower, the bank sells the mortgage note on the secondary market. This process is what keeps interest rates relatively stable and ensures that a lender in a small town does not run out of money just because they have already issued a dozen loans this month. The major players you will encounter are Fannie Mae, Freddie Mac, and Ginnie Mae. Fannie Mae, or the Federal National Mortgage Association, is the largest participant and was the first of its kind. For the exam, remember that Fannie Mae primarily buys conventional, FHA, and VA loans from large commercial banks. Freddie Mac, the Federal Home Loan Mortgage Corporation, was originally created to purchase loans from smaller savings and loan associations, often referred to as thrifts. While their roles have blurred over time, the exam often tests Freddie Mac's historical connection to these smaller thrift institutions. Both Fannie and Freddie are government-sponsored enterprises that set the standards for what are known as conforming loans. If a loan meets their specific criteria for debt-to-income ratios, down payments, and credit scores, it is considered a conforming loan and is easily sold in this market. Non-conforming loans, like jumbo loans that exceed the dollar limits set by these agencies, cannot be sold to Fannie or Freddie and are held in the lender's own portfolio or sold to private investors. Ginnie Mae, or the Government National Mortgage Association, is a critical distinction point on the test. Unlike Fannie and Freddie, Ginnie Mae is a division of the Department of Housing and Urban Development and does not actually buy or sell loans. Instead, Ginnie Mae provides a government guarantee for mortgage-backed securities that are specifically backed by FHA and VA loans. A classic trap on the national exam involves a question asking which entity does not purchase mortgages directly on the open market, and the answer is Ginnie Mae because it only guarantees the performance of the pools of loans. You should watch out for trick wording regarding the flow of money. The secondary market never lends money directly to the public. If a question describes a borrower walking into a branch to apply for a mortgage or sitting down with a loan officer, that is strictly the primary market. If the question describes a bundle of thousands of mortgages being sold as an investment vehicle to a pension fund, that is the secondary market. Another common confusion point is the term liquidity. In the context of the secondary market, liquidity means the ability to turn a non-liquid asset like a 30-year mortgage contract into immediate cash. To keep these straight for the test, use the phrase Fannie buys from the big guys, Freddie buys from the thrifts, and Ginnie gives the guarantee. This helps you remember that Fannie Mae handles large commercial lenders, Freddie Mac handles the smaller thrifts, and Ginnie Mae provides the government backing for federally insured loans without actually purchasing the debt itself. On your exam, look for questions that ask about the primary purpose of the secondary market. The correct answer usually focuses on how it stabilizes the primary market and ensures a consistent flow of funds for homeownership across the country. Without this secondary layer, interest rates would vary wildly from city to city based on how much cash local banks happen to have in their vaults at any given moment.